Is the market on the brink of a major crash or primed for a massive rally? This question is crucial for your investments. Today, we'll break down the latest insights from our experts on stock market trends, potential risks, and the surprising data shaking up sectors from tech to small caps. What videos will we be covering in today's episode?
First, Matt dives into whether we're seeing the start of a market crash or just a healthy pullback. Next, Michael Silva outlines key stocks to watch and market conditions to be wary of. Then Mike provides insight into the S&P 500's decline and the rotation out of mega-cap growth stocks. Jeff Snyder breaks down the latest CPI report and its shocking implications for the economy. Finally, Craig Hemke shows how to profit from the current distribution selling in tech stocks.
First, Matt dives into whether we're seeing the start of a market crash or just a healthy pullback. Next, Michael Silva outlines key stocks to watch and market conditions to be wary of. Then, Mike provides insight into the S&P 500's decline and the rotation out of mega-cap growth stocks. Jeff Snyder breaks down the latest CPI report and its shocking implications for the economy. Finally, Craig Hemke shows how to profit from the current distribution selling in tech stocks. Welcome to Trade Brigade on YouTube. Today's burning question: is today the start of a market crash? Our host Matt is here to unpack it all. Buckle up, folks.
Absolutely. It's a roller coaster of financial insights. Matt mixes some good news with the bad to give us a thorough analysis. Ready to dive in?
So what's the main juice here? Are we really on the brink of a market crash?
The core thesis is this. While a crash is always possible, Matt argues the current data doesn't show it. The evidence simply isn't compelling enough for the sky is falling scenario.
Let's break down those key points. First off, the market data. What's Matt seeing there?
Matt highlights the upward trends in the SPY daily chart, despite some profit-taking at all-time highs. Tech stocks like Tesla and Nvidia did see sharp pullbacks, but small caps rallied on better-than-expected inflation data.
How's the sector performance shaping up?
Mixed but not catastrophic. Communication and tech sectors show minor losses, but no sector is down more than 1.37% for the week. More importantly, market internals like breadth ratio and volume inflows are looking healthy.
And what's happening with the economic indicators?
The dollar's down and interest rates are falling, both positive signs. Credit spreads also show no signs of stress, which makes a crash unlikely in Matt's view.
Okay, crystal ball time. Any predictions from Matt?
Absolutely. Matt sees potential minor pullbacks and consolidation, especially around key levels like 54,950 for SPY. He stresses that any significant downturn would need a big change in market internals or broader sell-offs.
So, what's the game plan?
Monitor those market internals and sectors closely. Look for pullback buying opportunities and manage risks smartly. Matt's not suggesting we should panic, but rather stay vigilant.
Wrapping it all up, what are we taking away from Matt's analysis?
Matt concludes with cautious optimism. Short-term pullbacks are likely, especially in tech, but broader market signals are bullish. His advice: stay smart, look for buying opportunities, and manage risk carefully.
Welcome back to Figuring Out Money. Today's main event, a market overview and what it means for your stocks. Strap in as Michael Silva breaks down the recent market movements, what's hot, what's not, and the signs you should keep an eye on.
Absolutely. Michael uses his market expertise to show where the risks and opportunities lie, especially when the market seems to be playing a game of cat and mouse with our emotions.
So what's the main theme Michael tackled in today's video?
It's all about volatility and opportunity. Despite some stocks showing gains, there are lurking risks, and staying vigilant is key. Michael stresses the importance of preparation, whether you're riding high on a winning streak or stuck in a losing skid.
All right, let's dive into those key points. What stood out about the market performance?
JP Morgan had a miss with their predictions. The market reacted differently than expected. Small caps made significant moves, but risks remain high. Core inflation data came in at 0.1%, yet the market didn't react as forecasted by JP Morgan. It discounted that information ahead of time.
Interesting. How did Michael say we should handle these market conditions?
He suggests caution after consistent winning or losing streaks. You must be prepared for market shifts. Understanding market flow is vital. Today's heavy put options indicated a possible downturn, for example.
What upcoming events should investors be prepared for?
Tomorrow brings PPI data and Michigan consumer sentiment reports, which could influence markets significantly. Plus, bank earnings from major players like Wells Fargo, Citigroup, and JP Morgan are around the corner, potentially stirring up more action.
Moving on to technical analysis, what should we be watching?
Michael emphasizes key technical levels. The weekly and daily expected moves are crucial. He also discusses bearish and bullish patterns that could influence future market behavior.
Any specific stock picks or ETFs that Michael mentioned?
Yes, several. IWM and TSLV stood out among ETFs. For stocks, big names like Nike and Starbucks, which have been beaten down, as well as some under-the-radar picks, are all in Michael's spotlight.
It's prediction time. What's on Michael's radar?
First, bank earnings. They could inject volatility into the market based on performance. Second, the upcoming PPI and consumer sentiment data. These reports might drive significant market moves, so investors should brace for possible turbulence.
To wrap things up, what are the main takeaways?
Michael underscores staying informed and agile with your trading strategies. Key data releases, earnings reports, and technical indicators are crucial for navigating through the market's choppy waters. Be prepared and stay sharp.
Welcome back to Mott Capital's Market Chronicles on YouTube. Today's hot topic, the S&P 500 drops, but oddly, more stocks are trading up. What's driving this topsy-turvy market?
Yes, it's been quite the day. Mike, our in-house market analyst, provides a deep dive into the reasons behind this peculiar rotation out of the big mega-cap growth names.
All right, so what's the essence of Mike's analysis today? What's shaking up the S&P 500?
The main idea is that the S&P 500's recent drop is caused by a sell-off in mega-cap and high-tech stocks. This is mainly due to a weaker-than-expected CPI report, leading to lower interest rates and a rotation into smaller, cyclical names.
Let's break it down point by point. What's driving this market rotation?
Firstly, it's the big sell-off in mega-cap and high-tech stocks. The CPI came in weaker than expected, which pushed down 2-year Treasury yields by 10 basis points to 4.5% and 10-year yields by 7 basis points to 4.25%.
And what does this mean for small caps?
Lower rates could be good for small caps, but these stocks usually trade more in line with credit spreads. The iShares Russell 2000 ETF, IWM, had a strong day, but we need to see if this momentum holds.
Got it. What about the technical analysis?
Key resistance levels need to be cleared for a significant rally. The S&P 500's Relative Strength Index, RSI, recently hit 81.6, a highly overbought level, indicating caution.
Interesting. And what's happening with those mega-cap stocks?
Mega-caps like Nvidia are showing bearish patterns. A rotation out of these big names could spell trouble for them.
Finally, let's talk about the yield curve. What's the scoop?
The yield curve steepened slightly, hinting at potential rate cuts soon. Historically, this has been linked to rising unemployment and possible recessions, signaling more market volatility ahead.
So, what's Mike predicting for the market?
Mike believes that for a sustainable small-cap rally, we need significantly tighter credit spreads. Also, expect increased market volatility if the yield curve continues to steepen, hinting at rate cuts and economic slowdown.
Summing it all up, what do investors need to know?
Mike emphasizes the importance of closely watching credit spreads and yield curves. While small caps have a chance to rally, many indicators suggest caution. Be prepared for potential market volatility ahead.
Welcome to Eurodollar University, where we tackle the latest economic headlines and make sense of it all. Today's topic, a CPI report that's knocked everyone's socks off. But before you break out the champagne, there's more brewing underneath the surface.
Absolutely. Jeff Snyder takes us through the latest Consumer Price Index report, unraveling the good, the bad, and the downright alarming. Let's get into it.
First things first, what's the core takeaway from Snyder's analysis?
Well, the headline might seem like good news, declining consumer prices, but dig a little deeper, and it's clear that this disinflation is signaling broader economic weakness. Essentially, it's a flashing warning sign of a possible recession.
Okay, break it down for us. What stood out in the CPI report?
First off, June saw a decline in consumer prices, something we haven't seen this cycle. And it wasn't just gasoline. Services were flat, rents and auto prices slowed down. It's a broad-based disinflation, not just a blip.
Wow, that's significant. How rare is this kind of drop?
It's quite rare. In fact, in the last 100 months, this is only the fourth time we've seen the CPI negative on a 2-month basis. The other instances were during severe economic disruptions like the 2020 lockdowns and the 2016 oil crash.
No kidding. So how did the market react to these numbers?
Interest rates took a nosedive. We saw more bull steepening signals in the 5-year and 10-year spreads, showing that investors expect rates to fall. It's like everyone suddenly hit the economic panic button.
And what about the broader economic indicators?
Weak consumer spending is a big red flag. Companies like Target and Walmart are slashing prices because people just don't have the disposable income. Rising unemployment and weak incomes are adding more fuel to the fire.
Time to dust off that crystal ball. What predictions did Snyder have?
First, we're likely heading towards a recession, driven by these weaknesses in consumer spending and employment. Second, with the Fed likely stepping back, interest rates might fall closer to where swap market rates are, which isn't a great sign.
Wrapping up, what's the big picture here?
Snyder's main point is that while the surface numbers might look rosy, they're actually hiding more serious economic weaknesses. The disinflation we're seeing points to a potentially rocky road ahead, making it crucial to stay cautious and keep a close eye on ongoing developments.
Welcome to the Technical Traders channel. Today's hot topic: how can you profit from the current distribution selling in tech stocks? Our favorite market sage, Craig Hemke, is ready to break it down for us.
Absolutely. Craig dives into the nitty-gritty of today's market frenzy and how savvy investors can turn this chaos into opportunity. Buckle up. It's going to be enlightening.
All right, what's the main takeaway from Craig's analysis? Why is everyone in tech stocks freaking out?
Craig's core thesis is that this sharp sell-off in tech stocks is just the market's way of going through a normal distribution phase. He believes it's not an apocalypse, but rather a chance to potentially profit.
Let's get into the nitty-gritty. What did Craig say about the current market behavior?
Well, the market initially moved higher due to economic data, but then plummeted, particularly in tech stocks. Craig highlights a crazy short squeeze involving the SQQQ, pushing the market to overbought levels.
Sounds intense. What about this distribution phase he's talking about?
Craig explains that these sharp pullbacks, known as distribution selling, are just par for the course. Institutions are dumping tech stocks and shifting funds into small-cap stocks, which are now on fire.
And sentiment-wise, how are things looking?
Craig mentions a spike in fear and panic selling, but similar spikes in the past have led to market upticks. The S&P 500's pullback to its 5-day moving average is part of the game plan, serving as a support line for future gains.
All right, time for some crystal ball action. What does Craig predict for the market's future?
He predicts that this tech stock pullback is temporary. The Nasdaq and S&P 500 will likely find support and resume their upward trends soon.
And what about the smaller cap stocks?
Craig foresees that the rotation into small cap stocks will continue as investors hunt for new opportunities while giving big tech a breather.
So to wrap it all up, what are the big takeaways?
Craig's main message is, don't panic. Today's tech stock sell-off is typical market behavior, not the end of the world. Stick with the upward trend and you'll be in a good spot.
Our experts provided a range of insights on current market conditions. Matt remains cautiously optimistic, seeing bullish signals despite minor pullbacks.
Michael Silva warns of potential turbulence and stresses staying informed.
Mike highlights the bearish patterns and rotation out of megacap stocks.
Jeff Snyder points to economic weaknesses, predicting a recession.
Craig Hemke reassures that the current pullback offers profit opportunities.
While opinions vary, all experts agree on the importance of strategic caution and market vigilance.
Thanks for watching Financial Analysis in Review for July 12th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.